Good evening, ladies and gentlemen. This is Clueless Trading Frank. It's approximately 8:13 p.m. on February 4th, 2019. This is a strategic Clueless Trading webinar, market and stock updates, as we normally do. Because due to the Super Bowl schedule last night, we are doing the weekend webinar today on a Monday evening. Full disclosure, this is purely for financial education, not for any solicitation or advice. The session will be recorded and uploaded to the Google YouTube channel for viewing by all members or anyone out there with an internet connection. Do pass the word around. Want everyone to spread the word on our Instagram promotional presence at Clueless Trading on Instagram. Certainly appreciate a lot more followers. It is not real-time content, which is only delivered for members on the private Twitter feed at Clueless RT. That's for real time. The Instagram account is primarily for promotional purposes to get the word out there on a few highlights of what we do within here at Clueless Trading. So certainly would certainly like you guys to get a lot of your friends and stuff to follow. On that note, let us begin. It's been a long and exhausting Monday. I'm not quite sure why I feel so tired, aside from the fact that we are delivering some serious, actionable content, which is producing some very serious profits across the board, both on the swing trading side as well as on the day trading side aspect of things. There are many different types of traders. There are swing traders, there are day traders, and the combination of both is what really makes a trader. My charts are designed to help all members, all traders of all stripes and colors and styles to benefit from the markets, whether they be a down market or an up market, and in many cases a sideways market, which are the most difficult to trade. However, there are multiple different types of alerts that are put in place. Want everyone to understand that we're not just in the business of trading the Googles, the Tesla, the Netflix, the Apple, the Facebooks of the world. We are in the business of looking at opportunities, which in many cases can be stocks, names that you haven't heard of, but that shouldn't preclude you and stop you from taking those trades, whether they be a reversal trade on such as Edward Life Sciences. Many of you don't even know the name. It is one of the top American companies on the life sciences group, on the biotech side, healthcare side, I should say, and even a reversal trade from 40 cents to $1.20 is a net 200% on intraday return on investment, or ROI. Anyone can do that. Anyone can do that. Don't have to outlay, you don't have to put out too much money, and you certainly don't have to worry about whether or not a $6, $7, $8 call is blowing up because of the volatility in the market. These are fantastic trades. We have multiple lotto trades, we call them, which are generally less than $1 or $2. We have stocks like Coty, COTY, which is a swing trade. We have, example I just gave you, EW. We have stocks like ePay. Many of those type of lotto plays, which have previously delivered some significant results. And if they go the other way, you don't have to be sitting there wondering why, what happened. Saying all that, we are still in a highly volatile period of the market, even though we are trending higher. And we're going to go through the charts in a few minutes. Even though we are trending higher, we are starting to reach some extreme overbought levels. I shouldn't say crazy extreme, but extreme short-term overbought levels, which simply means, in simple English, that the markets are due for a quick, sharp pullback. That sharp pullback can be anywhere from 100 to 200 to 400 points and can happen instantaneously within a matter of hours. Not minutes, but hours. The minute flash crashes that we get, where the market drops 300, 400, 500 points, are not rare, but they don't happen that often. And when they do happen, we have taken full advantage of them through intraday SPY shorts as well as buying the tactical lows and the reversal trades, and the reversal reflex bounce, which are again equal in length and time to those flash crashes. We have seen that happen repeatedly, and you can see that in visual form in this particular tactical trading roadmap of the E-minis, the 15-minute version, which shows a lot of movement. Each bar is 15 minutes. And this is a representation of the overall structured volatility in the stock markets, what we call the S&P 500, the real traders market. So, saying all that, always be prepared for quick, sharp, intense volatility. That's something that is completely out of our control. However, we can certainly control our trades, whether they be a quick exit or buying and cost averaging down, buying the range lows, and then having a 175-point rally that started at around 9:45, 10 a.m. As you can see clearly, my arrows were put in place prior to that happening, and if you reacted fast enough, you got yourself a very healthy return on your money, even in something as simple as the spiders, the SPY, which went from $1.48 to $2.42. So $2.42 from $1.48, I'm just giving you the exact numbers, is roughly 63% intraday reversal, even if you didn't have anything the prior day. So that's what we do. In time, as you do more trades, as you finesse your style, you will see that the content that I'm delivering can be used to your benefit in whichever style you want to trade in. There is no one style per se. There is a certain method that I follow, a very disciplined method, as you know, on trading these robotic markets. Some people get it, some people don't, but that's okay. My job is to basically keep on producing this premium content so that you all can benefit from it. Adapt it to your own style. At least you know where the pitfalls are and where you're going to fall into that big canyon, or hopefully not, and how you can climb up, climb from it. That's what these charts are all about in real simple terms. Saying all that, a couple of broader points. We are in a week where most of the foreign markets are closed because of Chinese New Year, especially the Asian markets. And I believe the Chinese market, I don't have the exact thing, it will be closed for the entire week. And certain Asian markets will be closed for a whole bunch of days. That means the onus of responsibility, if you want to look at it that way, relies on the European, primarily the American, United States financial markets. The deepest, most liquid, and the most phenomenal of all stock markets of all times. That's my view. Saying all that, so that's something to keep in mind, that we will not, at least for now, for the next couple of days, just bear with me 1 second. Sorry about that. For the next couple of days, we will probably not have any massive overnight Globex type of volatility in the Globex session, the global market future session, and but hey, anything can happen. But that's my hunch on this coming week. Saying all that, intraday volatility is a constant. And overnight volatility is always a constant, might be minimized because of the absence of the Asian participation, which are heavy duty markets, the Shanghai Exchange, the Hong Kong, the Taiwanese markets, the Korean markets, and like they say, they'll be sporadically open during the week. Okay. The other thing that's happening is, of course, President Xi and President Trump supposedly meeting in Vietnam at the end of this month. I put that out. That was breaking news on the South China Morning Post. As you know, I do a lot of work on the background. I'm constantly tuned in, whether I'm watching the Super Bowl or I'm constantly keeping an eye on international developments, which is a huge benefit to all serious traders because the tweets go out there if it's something worthwhile and will affect our movement the following day. So South China Morning Post, I saw that they announced last night that President Xi, there was some sort of talk that President Xi is going to meet President Trump in Vietnam on a summit, and that's obviously a big deal. Aside from that, what we are going through right now is earnings season. I don't need to remind you, we have had some phenomenal earnings winners and we had a couple of flops, but most of them have been big, big winners. When you do a basket strategy on earnings, as you all know by now, then you tend to win out quite often. You might have one or two that go splat. That's a technical term for saying belly up. Just kidding. But that simply means it didn't work out. But then you get the others which go from $3 to $11. Case in point, today was Clorox. Clorox, the bleach company. Mom and pop knows Clorox. And I said to buy that PR. The 150 calls went from roughly $3 and change, $3 roughly. At one point slightly lower than that when I posted it on Friday, to $11.20. That's close to a 300% net ROI, return on investment. Could have bought one. Like to always remind everybody that what you don't make is what you lose, and that is a fact. Many people don't want to accept it, but that's just that's the way it is in life, and that's what it is in trading. If you sit around and do nothing, you're just going to do nothing. That's it. I'm not here to tell you what to do. Just trying to motivate you guys to be involved. That's all. Okay. So from a standpoint, yeah, the main focus right now in the markets are earnings. Google down 12. People, oh my God, it's down 12 points. It's down 1% from flat from what it was this morning. In the middle of the day, we made 50% on Google. We have a straddle in place. I don't go, knee deep into that type of trade. I said buy the QQQ. You can certainly look at my Twitter feed. I said the best way to play Google is to play the Qs because that's the NASDAQ 100 and Google's one of them. And that would be the best way to play it. So the Q's down is far less pain than if you bought a $22 call or a $19 call or a $15 call on Google, even with the straddle, and that it's down to $2 or, because it sucked the premium out in the morning. It's just the way it works. If you bought the 1200s all the way out, you can lose less because you paid less. That's just the way it works. All right. Okay. Now, so that's what's driving the markets right now. Saying all that, let's just get into the charts. I want to, but I have a busy evening here on the family front, and I need to get this thing done quickly. So what we're seeing in front of us right now is a daily of the markets. You can clearly see what's going on. We have an important technical signal here that occurred on the 25th of January. 25th of January was, I believe, a Friday. And this is what happened. And I mentioned that too. There was a 3450 crossover. This line is a 34-day simple moving average. That's a 50-day moving average. Sorry about that. I got an important text, so I have to respond back. Okay. And this is generally signals that there is a possible trend change in trend, whatever you call it, directional change. And if you zoom in, you're going to see that you're starting to see that. Okay, right there. That occurred on the 25th. Now keep in mind that you don't need to wait for a trend change in order to make serious money because the markets went up 2,000 plus points from the 24th, 26th of the day after Christmas, after one sharp drop here on the 3rd of the beginning of the year, January, and the trend change occurred almost a month later. That's just the way it works because this is a daily chart. It requires 30 days of moving averages to show. In the meantime, we don't wait around. We trade along the way. We took staggered profits. We moved on. We kept on rolling our strikes higher on the SPYs when I'm talking about SPY here. And this is what happens. So keep in mind, there's a lot of things you learn as time goes on. I'm self-taught when it comes to advanced technical analysis. The basic tenets of technical analysis I learned on Wall Street. Like I said many times, I remind people again, I had an opportunity to sit with some of the top technical gurus of the world, like Ralph Acampora, Luis Giammatta, Tony Dwyer, even Carter Worth. So I've attended direct seminars and stuff that Wall Street holds back in my days on Wall Street. And but then the style that I developed, which was my more advanced style to look at things beyond what they look at, that certainly, worked. So saying all that, you guys have you guys will be learning a lot, but your learning is accelerated because you're with Clueless A Trading, and I spend a lot of hours working with you guys on advanced coaching sessions and a lot of hours providing these type of strategic updates where I explain these technical terms so you don't have to wait around for 5 years to understand what the heck's going on. So take that, respect that effort, and your learning should be highly accelerated. Even going through my Twitter feed at the end of the day and scrolling down with all my comments, all my charts, all my visual representations, that itself is an automatic accelerated learning process for all of you, which will help you manage your trades better. That's all. So this is a powerful signal here. We are moving quite fast, quite rapidly. So the further we move away, in the simplest terms, away from these moving averages, that means we are getting overbought. We were deeply, deeply oversold with the standard deviation of almost -7, if not more, back on the 24th on the Christmas Eve massacre. And if you look at this candle that started on the 14th of December, so we moved away from these highways that the market normally likes to hug and travel on or stay above. But we completely deviated from there, and that is a very, very negative standard deviation, which was intense. I did say the markets would bounce, and boy, did the markets bounce. That's just the way it is. It's not just guesswork. This is technical guesswork, and that's where the money is made. So we are moving fast, and the further we get away from here, the bigger the pullback will be in order to come back, what we call mean reversion, technical terms. The mean reversion simply means that it is going to come back and try to come closer to these moving averages. This is the mid-Bollinger. This is your 50-day moving average, always in red, and always in orange or dark orange is your 34-day moving average. So, in simplest terms, the further we move away from it, that means the standard deviation on the positive side is getting stretched. That means markets are getting very stretched, and they will tend to deviate, and they will tend to mean reverse or come back towards these moving averages. Exactly when it happens, how it happens, that I put out on the real-time charts, on the real-time Twitter feed, and all you have to do is focus and just keep an eye on it. So we are not that stretched yet, but we're getting there. We're getting there. At this level here, at around the 2,800 level, which is really not too far away. It's only about 80 S&P points away, which means that it's about 480 to 500. That can happen within a day. You know that. And once you get to this level here with a big fat supply zone or massive breakdown started, you can rest assured that the markets will hit a major wall of resistance, not the minor wall of resistances that the market hits every single day. And then it go higher and tends to pull back, test those different levels, and then move higher, as was the case today from the morning to the end of the day. And then you hear the talking heads, the complete idiots, if you ask me, when it comes to technical analysis and all that stuff on TV, telling you, "Oh, is the market really about to go?" All that garbage that you hear. The reality is that we haven't hit a major technical level that comes around about 400 to 500 points from where we are right now. But we have to be cautious. We have to take profits along the way just in case we get a quick sharp pullback. Remember, this line here was the 2018 break-even line, so we could very easily drop about we can drop 2671. We hit 2721, so we could very easily drop let's see, 20, 30, 50, about 300 points very, very quickly on any type of news that might break. Remember, the other big risk, which I forgot to mention, is, of course, Feb 15th, the government shutdown fiasco again if no border wall deal is done. And that is a major risk, and the markets are not going to like it. So, one step at a time, right? And tomorrow's State of the Union address by President Trump is going to be rather revealing, because we'll kind of figure out we're going to try to figure out whether or not he's getting some semblance of any type of agreement, or just some sort of talking with the opposition. The Democrats control Congress and even some senators, whether or not they will have some framework of a deal on the border wall side. And if not, then the market's not going to like it. The other danger to the market is this stupid Brexit crap that's happening in the United Kingdom with Theresa May, who is trying to get a somewhat reasonable Brexit deal coming through. I don't think she will take the risk of a no-deal Brexit with the European Union, in which case the United Kingdom, Britain, is going to be hurt very badly. The big banks have already said that they're going to be pulling out of there, moving their operations to Frankfurt, Germany, and to Paris, and nobody wants to see $2 trillion moving out of the city of London into the hands of Frankfurt and Paris. And it's just not good for anybody, and it certainly will affect the the United Kingdom economy, and will have repercussions in the U.S. markets as we deal substantially, especially on the financial side and other trade side with the United Kingdom. It's not going to help anybody. So I don't think Theresa May is going to be taking that risk. So that's another risk that's in the market right now. All right, just keep that in mind. Okay. So showed you the daily chart on the E-minis. You can see what's going on here. Uptrending, staying above 80, all kinds of good stuff. Markets, the bulls are in control at this point. This is the SPX, the GAN fans. Want to see the definition of a GAN fan? Please go to Investopedia and put it up there. And so if you look at this fan here, the next level of the fan gets hit very close at around 2740. I've been talking about S&P 2730, 2740, and we actually hit 2725 at the close today. Yep, 2724.99 was the exact number. You cannot get any more accurate than this if you're trading the overall market in the form of SPX or SPY calls. Really, all right? Think about it for a minute. I'm giving you trades within a matter of points. That's like a sniper from 2 miles away taking out an ISIS terrorist. Seriously. Sniper style. All right? I'm not kidding around. So that's your first GAN. The next GAN, this is the major support level, the breakdown point that was the 4th of December last year when the world broke apart. Sudden move when everything was going fine, and then there was a nice change the color. This was a dragon bullish W formation starting to form, and then all of a sudden, bang! So this is a major supply point or major resistance, and that is coming in at 2788. Don't have to know the numbers, you just have to look at the charts, and that's it. This is a matter of resistance. This is a GAN fan, which is also a downtrend line, right? We broke through this downtrend line, and that was on, you guys know that by now, that was on the 30th of January, a couple of days ago. And now we have a bull flag that's going towards this level here. When I'm trading the SPYs, I trade levels. Because if you listen to some of the best futures traders out there, some of them have their YouTube videos and everything, they'll tell you they take money in between levels. We do the same thing. We try to take money selling on the upper end of the level, because the minute it touches these lines, there are massive sell programs that come through. So if you're sitting around, don't have a sell order out there, or you're not watching things and you think everything's just going to be real sweet and thing, next thing you know, your profits are gone. Yep. All right. So we're getting close to it here. 2738, which is roughly about 15 more points from here. That will bring us to 2830, 2739, 15 times 7, roughly another 100 points, and we are going to hit a first major roadblock. That's why these Gantt charts are there. In order to manage your trade intraday, this is what we focus on. This chart, for example. This is both a swing and a daily day trading chart. I showed you the level here that we are going to trade between these levels. These were put pre-market. These were put last week. And if you traded this, you made yourself a decent sum of money. Not hundreds of percent. Yeah, you would have if you're trading this whole move. But I'm talking just today alone, this was good for 63%. We entered into the upper end of this channel. And then, we pulled back a little bit. This is where we are. Futures right now are down 3.25. This megaphone that I had drawn a while ago completes itself at 2750. So that's another 40 times 7. That's another 300 points from here. Okay. This chart we use extensively for trading the ranges. It's very easy to read. Here's your range. We broke out of it at around 1:30 in the afternoon today. Pulled back and retested at 3:30, and then a big fat candle that came into play at 3:45 p.m. Markets will do what they need to do, regardless in many cases of the news. If there is a big concentration of shorts that the machines want to destroy, then they will basically take the markets higher. You're wondering why? Oh man, there was bad news. Why did the markets go up? Because the markets don't give a you-know-what. And I've started to explain this to people for many times, and some understand, some don't, but that's not my problem. Markets have a predestined move. And so if you look at the open interest on the SPYs and stuff, you kind of get an idea, what the maximum pain level is. Go to Investopedia and put these terms in so you can, understand the definitions. But what the max pain is, or what the open interest is on the SPY for a certain month or a certain week, and the markets will basically try to get there or decimate puts in order to get there. It's just the way it works. So at this point, this is your day trading chart. You can certainly control your trades very effectively by looking at these. These are 15-minute candles, and it's a pretty defined pattern here. The red line means support, the green line means resistance, the upper end is what the upper end is. This is your acceleration channel that we are traveling in till 4 p.m., and this is where we are right now, just a few points lower. Okay, next. This is a swing chart, a swing and a day trading chart, very defined, very clear. And I keep on updating them all through the day so that you guys know exactly what you guys need to do or where we're heading. Is the trend still up? The trend still overall looks up because uptrend channels are all intact. Again, uptrend channel breaks below 2708. Then we have a quick shot back towards the 2700 level where we were at this morning at around 9:45 after the market opened, right? Stay technical, stay tactical, because like I always like to point out, and I write that down, our opinions and emotions are completely worthless. Yes, we need to have our opinions and emotions, but that doesn't mean that has to get in the way of making good trades. This is a swing chart, which is a 1-hour chart, and you can clearly see what's going on. We are in an ascending triangle, which we broke out of at 8 a.m. on the 31st of pre-market, on the 31st of December of January, which, ladies and gentlemen, was last Thursday. Now we are here. If you look at this chart, the first thing that like they say, sometimes you just have the more you look at charts, you got to talk to, your first instinct is going to be the right instinct in most cases. When you look at this chart, it certainly, I don't need to ask this question because it's pretty obvious, looks like an uptrending chart. So if it's an uptrending chart, I've drawn the channels of where the uptrends can be, and that's why you have these white channels. And this white channel here goes to 2850. Being a swing chart, this is looking out, or at least trying to predict what will happen maybe a couple of weeks from now or in the month of February. I am looking to see what if we break out of this second ascending triangle level, which is where we closed at 27.25. You can't get any better than this. We closed exactly at this 27.25 level, which was the last sell point. The next sell point, which was back on the 4th of December at 7 a.m. pre-market, is right here, drawn. This line's been drawn for you guys at 27.87. That's 55 points higher from here, roughly translates into, 400 points on the Dow. So if you look at this, it doesn't look like we're really overstretched. I know it doesn't. So channel trading is a style that many, many traders use, and I certainly show it. And then you have the ranges where we can, there's your red line. You don't want to cross this red line. That's 26.74. We certainly, don't want to be held hostage, because once it breaks here, we could very possibly fall into this lower range, which will be quite a few hundred points down. But we're going to go with what's in front of us right now and what we can see. The bulls are still in control. We covered this. We covered this. This is a bull flag breakout again. This is the weekly chart from the market standpoint. I just want to show this to you guys very quickly. I've shown this many times. This is certainly a very powerful chart showing that we still might have 2 more weeks of a sustained higher move in between intraday volatility and pullbacks and panic fears and stuff. Why? Because we have the histograms, which I've been talking about for a while. I started talking about it back from the lows in the market, back on the Christmas Eve massacre and the following day after Christmas, Boxing Day in the United Kingdom, when we first started to turn here, that we need to get overbought, and we will get overbought once we get to this level. You do not need to be a technical rocket scientist to figure this out, because the visual representation itself gives you the answers. So if you're swinging long, taking profits along the way, you'd want to be a tactical dip buyer, as long as these indicators, such as the histogram, which is now MACD histogram, which is now second week positive. Remember, this is a weekly chart. Second week positive. Last time something like this happened, where we crossed over this line, which we crossed over from 2,500, we had a multi-week rally in January. So at this point, I am not calling for a multi-week rally. I am, but I'm basically saying that we probably have 2 more weeks going into the middle of the month, and then things start to, get severely overbought on the intermediate swing perspective. This crossover is extremely bullish. This is certainly bullish. This shows us that we have more room to move, even though we are getting into that overbought zone. We have 1, 2, 3, 4, 5, 6, 7 weeks now, with 1 week slightly down, which was itself a very bullish indicator, because it was, and I've covered this in my previous video cast, a hammer reversal. So while the media was like, oh, is the market stopped going up because we had a down week, we looked at it from a technical perspective and called it right. As you all know by now, that this was a hammer reversal above the megaphone. You never hear this stuff like in other services. Maybe you do. I doubt it, because if you do hear this stuff in some other services, certainly clue me in, because I like to listen to them. All right? That a hammer reversal over this megaphone, which I showed, explained, and guided people through. You're definitely not going to hear this in the media. All they do is like, oh, here's the moving average. It broke the 200-day moving average. Well, who gives a flying what? Because you can't trade that, what they're saying. What we can trade are these charts. Think. So, this was a bullish week, even though it was down, and then it created, the end of the week created a beautiful hammer. The following week, which was last week, we were down first, creating a massive body of a reversal hammer, a green, fat expansion body, not just a reversal hammer, confirming the move higher. At this point, the real tactical dogmatic bears are getting worried because there is nothing here. This I just want to show in simplistic form. This was a huge sell candle, right? Back in November. I mean, back in, one sec. Back in this December, first week of December. So at this point, we have pattern symmetry is almost mandatory in the business. And you see that more and more on my chart. I know many of you, especially newer members like Drew and stuff, have never seen anything like this. They haven't. I'm not talking about the market going higher. The market's gone higher already. But actual pattern symmetry where you can see this in visualized form and trade it. And many other newer members who will be looking at it, or your friends who will be visiting us on Google, YouTube, they will see this magic happen, both on the downside and the upside, depending on how you're positioned. So this move here, that now we have broken above this climactic sell zone here, which was the middle of December, and you can see we have re-entered, as I've said many, many times. And then this reminds me of something real clear. You guys all speak English. You guys all understand English. I write in very direct terms in English. When I say we re-entered over a major uptrend line going back to 2016, well, what's there not to understand? Here's 2016. Here is your major uptrend line. We broke below that on, we tried to fight and hold above it till the 3rd of December, the week of the 3rd of December. Then we fell below that on the week of the 10th. And then it was just, it's pretty much straight down overall, now that we look back at it. Now we have pushed our way up over this multi-year, 3-year uptrend line, this green line here. I've written this in simple English, so please read. Reading comprehension is very important for traders. I don't want to take you guys back to 4th grade, even though a lot of our 4th graders can't read, which is absolutely a terrible shame. So the fact is that we're above this downtrend line. I'm sorry, this uptrend line. We have re-entered it. This is a very powerful move. Doesn't matter what happens during the day. So if we keep this going, there is nothing in this vacuum here not to take us up to the 2800 level. I do not want to get overtly bullish, but from a swing perspective, it is bullish. Now, can it pull back a little bit, retest this line, give back 100, 200 points? Sure can. Sure can. We could even come down and retest this channel or the upper end of this megaphone at 2631. You all want to think the market's going to completely is finished. No, it's a technical move down. We do not want to be exposed too much on the long side. We certainly want to be in SPY puts if we are going to do one of these moves here. That was a major breaking news. Fed Chairman Powell met with Trump for an informal dinner to discuss the economy. Trump basically said, listen, Powell, cut it out. Feel the economy. Feel the economy. Which is a good thing to do. He felt the economy and took it easy, right? Fed Powell did that. That's why the markets went berserk. So this will be met with criticism from the Democrats and stuff, but overall, in my opinion, and I'm an equal opportunity critical kind of guy, being a New Yorker, I think this is overall positive, even though it will be criticized that he's manipulating the Federal Reserve. I think Powell is a good guy, and he'll do what he needs to do. So, okay, let's get back to this. So this move down here, which is possible, would be good for 300 or 400 points. You know that 2,600 to where we are right now. We lose 2,600, 124 times 6. No, that's actually a lot. If we move to the 2,600, well, this is good for about 600 points, and then we can move from here. Any type of negative China negotiation news can easily drop us 600 points. Boom, just like that. All right? So we need to be prepared to move fast, buy some SPY puts, whether it be intraday or overnight. I'll certainly try to guide you guys as much as possible. Saying all that, we are above this multi-year uptrend line. So this zone here, if things stay the way it is. Earnings are coming in, some bad, some good, but more than 70% of earnings that have come in are good, believe it or not. Not that the Wall Street analysts, some of my old buddies, are completely freaking idiotically clueless. They basically cut estimates, earnings estimates. Earnings is all about beating expectations. That's it. So they cut it so badly. Now there's some of these great companies are beating them widely. Look at Boeing. So saying, look at Clorox. Look at Honeywell. These are old line companies. Look at Facebook. So saying all that, so this zone here is a very dangerous part because the markets could very well take that in, move up real fast. But we have to watch it. We want to stay above this uptrend line here. We don't want to fall out of it too much. And we want to complete the first leg of a major pattern, which is around the 2800. That's your weekly chart. So weekly is doing fine. Now, if I do this, I showed you all that stuff. There's nothing more to report here. One more thing I want to show you before we go into and answer some Q&A on stocks and such, which is really the bread and butter of what we do. Let's take a look at the monthly. I haven't taken a look at it today. The monthly is actually okay. It's not flashing a massive buy signal. It flashed a massive buy signal here, and when it crossed over here back on the 1st of January. Right now, if I'm noticing, and if you guys are noticing, it is still moving higher, but it seems to be slight flattening. So that means the monthly is starting to hit a major resistance at this falling wedge, which is also a downtrend line, and we are slightly above it, believe it or not. The upper end of the channel going back to 2009 when we were all 10 years younger. The climactic generational crash where they said it was like 1929 times more. Well, it was pretty bad actually. Okay. Things were falling apart. So type of 1929 depression could have gone through. I didn't believe that, but there are too many modern tools not to go into a 1929 depression, even though the dogmatic bears will tell you a nice sob story about how we can go into a 1929 type of depression and everything's going to be the gold standard, blah, 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 blah. Well, I've heard it all. Saying all that, I want to get into that intellectual discussion right now. This is a massive uptrend channel, upper end of the channel right there. We're at the red arrow is around 2770. Right there you go. So far, so good. Trending higher. I'm going to hit some massive resistance at this level. And if we can cross that, we get to that 2800. So, net, still a bull flag. This is what a bull flag looks like. Big power move. No one believes. No one still believes. Which brings me to a very important tweet that I put out there. Let me ask you guys. Sure, you look at my tweets. What was the tweet about investor sentiment that I put out there today? Anyone remember, just in basic terms? Please, Drew, House, MB, Mike, which totally correlates and validates what I've been saying for months. Please, don't waste my time. Don't waste your time. If you know the answer, let me know. If you don't know the answer, then just say, I don't know.
Fear?
I'm sorry, what? Yeah, I know it's the fear. I'm talking about the Twitter article, headline that I put out there. Yeah, you're on the right track. Obviously, it has to do with fear because we're talking about investor sentiment. But what was the one that I put out there today? You might have missed it. You guys are busy. And that you guys might have read, which totally correlates with the fact that, what is going on and why there is more juice left. Okay.
Sorry, no, I didn't read it. Sorry.
Okay, this is TD. I put it out there on the Twitter feed this afternoon. It's from TD Ameritrade. Their investor sentiment clearly shows, and they covered it on CNBC2. More importantly, I put it out there, which clearly says that most investors, in which case pretty much everybody out there, mom and pop. Hold on for 1 second. Sorry about that. This TD Ameritrade sentiment that even though some investors have stepped in the market, they're completely staying away from the high beta growth stocks. Great. Those are the ones that are giving gazillion % in profits since December. Those are the ones that fell the most. So that's here. Investor sentiment. This is the one that I'm talking about. I found it. I put it out there at, and this is important. Not that it's a, right there. TD Ameritrade released an investor movement index for January. Retail investors, and remember, TD Ameritrade is big, so they see what all of you guys are doing, what I'm doing, what everybody else is doing. Retail investors remain, I would call it retail emotional investors, remain risk averse. That's an understatement. They're really risk averse. Trust me, overall. As US-China trade outcome looms. Blah. If you were to say trading, you'd know pretty much what's going on ahead of what's going on. And I put in my usual term, bunker scared and missing out on tactical reflex bounce rally as alerted, blah, blah, blah. So this is a major thing, that they are extremely risk averse. Simple English, all cash, mostly cash. Maybe they're nibbling a little at Apple, okay? Or buying a little Facebook, but the rest of it, forget it. So as long as it remains like that, we are good to go. Some of you are active, I know, are quite involved, but majority of members, I'm sure, are still sidelining, SOAing, sitting on you know what, which is good, which means there is more juice left in the market, cash on the sidelines. I don't have the exact number of what the cash on the sidelines is now. I know it was more than 3 trillion. They don't report that every week, but that's a pretty sick number. All right, so that's it. Then you hear the bears, like I put out there on my Twitter feed, like Rosenberg, just totally just. You see in his face, he's losing money right, left, and center. He's been losing money since 2009. In between, he made a couple of bucks on those quick, sharp, couple of month or two crashes that we get. And yet these guys get paid millions of dollars, like I said in the chat room. It is a terrible tragedy. It's horrendous. How do they pay that much money for being so wrong? It's just nuts. So anyway, I know most of you are still very scared, and that's okay. Take your fear and turn it into positive action. That's the way I look at it. You don't have to go hog wild. You don't have to go there and put your whole account on a Facebook and then quadruple your account and then feel like a crazy stuff. Wouldn't you guys have loved to do that? I wouldn't do that. But take it small amount and let it grow. Exponential growth with portions of your portfolio. That's the key thing. That's trade management. Simple. Let's say, for example, taking the lowest common denominator. Let's say $1,000. You take 200 of that and you put it into a trade that goes up 400%. You come and tell me where your account's going to be. You're going to have 800 left on the side. You took the 200 that went up to 800. You're up to 1,600. Your account is up 60%. Simple math. So you do that a little bit in the earnings baskets, a little bit at a time with a small chunk of your portfolio, you see the actual results. You don't do it, no, I don't play earnings, blah, blah, blah. All that garbage that I've heard for years, well, fine. Then you will never exponentially grow your account. Yes, you'll catch my amazing trades like Square and Roku and all that stuff, but Apple, all these things. But how about instantaneously growing your account with a small portion of your portfolio, such as buying the basket? One call. That's it. It's so simple, it's not even funny. Anyway, but what's not simple is the mental block. So work on that. This is Roku. You see exactly how it hit. I mean, I can't get any more precise on these charts, all right? And it pulled back. And it pulled back, but it's still a green hammer, and it was natural it was going to pull back because it almost kissed this lower end of the gap here. Stock is still on an uptrend. Part of Roku's move, was all technical. I've been talking about it. Was apparently yesterday, the online streaming services had huge eyeballs or viewership, because they were because of all the different ads and all that stuff. So that's one of the reasons. Big deal. Stock wants to go into the gap. Let's see if it does. Before that, it could very easily pull back to 42 and test the lower end of this wedge. Ready? Okay, so I'm going to answer a couple of quick questions, and we're going to wrap this up. Any stock anyone wants to see, please. No stock? Okay. Drew, question?
Could you do a Avago?
Avago. Yep, sure.
Wait, can you hear me now? Can you hear me now?
Yeah, I can hear you about it. Looks like somebody's waterboarding you, so you got to fix your mic, buddy. Just
All
kidding.
right, give me 2 seconds. I got a stock for you and a question for you.
Okay,
I'm fixing my mic.
give me 1 second. I'm answering one question from the other member, Avago. So Avago right now, as you can see, Mary, on the daily, it is right there, right? And
Mm-hmm.
if I now I got to go weekly to see what the heck's going on. So on the weekly charts, Avago is looking like it pretty much, there's not much to say. Given the strength in the semis, given the bounce back and a phenomenal reversal trade on Nvidia and stuff, Avago looks like it wants to test its highs, 286. So if you want to look at it, you want to buy calls like going like a couple of weeks out, nothing too crazy, and you can buy some outside strikes. You don't have to come close to it and buy the 285s. If Avago's earnings, which are coming up, I'm sure, it could very well blow up to 300 real easy. If things miss, it's going to come back and retest the 255 level and drop 20 points, which would be a buy at that point. Semis are tricky because their numbers are being good, but then all of a sudden, like STX, like Seagate, the stock was up to 48 bucks, $49, and boom, all of a sudden it dropped. Calls were cheap, so the loss is going to be minimal. It's a basket strategy, right? Because their guidance was soft, obviously, because of all these trade tensions and stuff. Remember, these companies have huge exposure to supply chains in China and in Southeast Asia, so they're worried. But so far, Avago's chart is excellent, and this chart was drawn obviously a long time ago. That's the reason why you're seeing it. And why did this happen? One
Okay.
second. Right there. So it's a beautiful. I mean, from a technical standpoint, it is MB. It is a fantastic looking chart. There's no question about it. Multi-week rally going up here, but then you could very easily see it quickly pull back a little bit. But so far, technically, it's it'll be one like Investors Business Daily that you look at, which is brilliant. Would be technically, it's I'm sure it's like up there with the A rating. You know what I'm saying? So yeah, it's good. It's certainly good.
Okay, thanks.
No problem. And we'll obviously play the earnings, because that's what because a lot of the times the machines will manipulate and hold the stock down and then just pump it up right into, right after earnings. So that's a standard procedure that hedge funds do. Hedge funds are always looking to, manipulate the market. They always do that. Even Kramer has said that many times. In his days as a hedge fund manager, they always do all kinds. They'll put a sell program out there for 50,000 shares. They won't probably even sell 50,000 shares. They'll just show they're looking to sell 50,000. The stock will drop $5 for no reason, so they can buy it cheaper. Drew, go ahead. Drew, I'm waiting for your question.
All right, can you hear me now?
Yeah, really terrible. You got to fix your mic at some point. Go ahead.
All right, Alpha Charlie Bravo.
Alpha Charlie Bravo. ACB?
Yes.
Okay. Oh, ACB. Yeah, that's actually on my list here. Good looking chart. Right now, it's looking. It's hitting major resistance here at 8. So you could see some back and fill. Very strong volume, no question about it. All pot stocks went through the roof. Whether it's Tillery, whether it's the one that one of our members suggested around 14, that hit 23 today. 23? Yeah, because I have the common. Yeah, it hit 24 today. That's Cron, C-R-O-N. Kronos, that's the name, right? So this one, basically, from a standpoint, it is at this point, this ACB is a much smaller stock. It can certainly blow higher and get to 10 real fast. But as you can see here, we have a major resistance at this $8 level. So net on the daily. Wow, let me change it. There. So this is known as a beautiful inverse head and shoulders or a cup and handle breakout. What has happened in a cup and handle, technically speaking? You create another handle. That handle can easily pull the stock back towards 7 before it attempts to break higher over 8 and hit the next resistance level, which is Obviously, in this type of case, a lot of retail investors are in it. They like round numbers, so you're looking at 9 and 10. So that's really what it's looking like. Technically, it's fine. Huge volume. Now, remember, when volumes are blood red and this high, that's called capitulation. Volumes are this high, and the stock hits the intermediate level, which is around that 8 level. And you know it pulled back a little bit after hitting 825. That also could be an exhaustion volume right there. All right, capitulation volume is like this. Exhaustion volume is like this. Is it exhausted? Yeah, I think it is a little bit exhausted, but that stock is certainly good to go. But it is a retail stock, so lots of emotional guys trading in and out. It is not an algo stock. So far so good. Okay, next question. I would be a buyer
No.
personally. I would be a buyer on either on a breakout. This is how technical guys look at it. On a breakout, fast buying, boom, get in there. Because I don't know what the short position is. If it's heavily shorted, they're going to run the stock to 10 real fast. They do that with these stocks. Or if it pulls back a little bit, I'd be a buyer between the $7 level, which would be more appropriate for me from a new entry point. Next question.
All right, cool.
I'm
Good deal.
good.
Thanks.
That's it.
Yes, Mary, what were you asking?
No, I said I'm good.
Okay, so we'll wrap it up. Covered a couple of things. Thank you for the questions. There's a lot. The last thing I'll say, ladies and gentlemen, there's so many stocks in the market which are coming off beautiful setups, technical setups. It's almost mind-boggling. I wish we could do it all, but we're not mutual funds, right? So I try to pick and choose the ones I know the most. And here's the secret. Here's the little secret about the stock market and about trading. You don't need all those stocks. You just need 1 or 2 or 3 to get your account way up there. Just have to have a reasonable sized position which just goes bang. And I've shown a whole bunch of them. So it is not about finding stocks. The ones that we have, and of course you have your own ideas, itself are generating significant amounts, whether it's a stock or the SPY or the QQQ. It is a question of your position sizing, your risk, not just risk management, how much risk you want to take. That's what takes you to the next level. So the secret is not that other services will tell you that, about doing scans at the end of the day to find more stocks. God, I have so many ideas that I give you guys. I have so many ideas that I'm looking at. Can't give you all. Can't trade them all. So who cares about scans? You're, I scanned and I have the next. I don't need to scan. I freaking can give you any stock, all the ones that I put out there which have gone through the roof. So it's not about how many stocks you can find. It's the stocks that you do, which are the solid setups. What are you doing with it? Are you putting enough money in it? Are you letting it run? Are you freaking out because it goes up and then pulls back a point or two? And I'm highlighting Roku because, this was a major breakout today. You have to ask yourself, were you here? Were you here? Were you even here? Or did you try to get in right here when it's hitting the upper level where it's going to pull back a little bit before it makes the next run? Question is, did you put enough money to make a difference to your, not just to your P&L, to your actual trading capital? That's the question all traders need to ask themselves. Think about what I just said, because that's what takes you from this level to the next level. Brings up the confidence level, become a better tactical trader, because it's difficult to be a tactical trader when you're emotionally shot in the head. You know that. We've all been there. Time to time, we all get emotionally shot in the head. But you can get out of that pretty quick. Have a great evening. God bless you all.